Just a reminder, everyone, of the disclaimer. So, anything we talk about today is for educational, entertainment, and information purposes only.
Hey, everybody. So I wanted to do a three-part series on the JPM caller. So this is a popular fund out there, and it's popular because of the strategy that it uses to create some downside protection. And it uses options to do that. And of course, options have become very, very big business in the last few years. This fund had about $500 million in AUM and assets in it 8 years ago. Today has almost 21 billion in assets in it. So this is in keeping really with the growth that we've seen in options markets in general. We've seen option volumes explode over the last 5, 6 years, particularly since the pandemic in 2020. And really, people have gotten interested in using options, harvesting options to generate income, to generate cash flow, which, by the way, you can download. As you can see on the slide here, you can download in the description below my options cash flow blueprint. It is huge. It goes step by step through my favorite strategies to create income from options, gets into some deeper stuff in there, stuff you're not going to see anywhere else. This is really an amazing, amazing giveaway. So download that for free below in the description. So, of course, this is what people are trying to do these days. They're trying to create this cash flow, but of course, they're using options as a hedging vehicle. And this particular product kind of combines two concepts. So it's kind of a fun product to talk about. And of course, we're going to do three parts. Day one's going to be high level overview, pretty simple stuff, just how it's structured, what it's trying to accomplish. Day two, we're going to get into the deeper stuff, gamma tutorial, why this matters to traders in particular, to options traders, but really to traders of the market in general. This is really a world where options have gotten so big that they are the tail wagging the dog now. Maybe they're the dog, we're not sure. But this is big, big business, and it has a real influence. We saw a big influence on markets in November, and so we're starting to see a big influence again today as we get near the end of March, which is where this thing expires and they have to roll into a new structure. So we'll get kind of deeper and deeper as we go along with these three lessons. So let's talk about what it is. So it's basically a put caller fund. It owns the market, a version of the S&P 500, but you'll see a little bit different. And what they do is they own the market and they overlay a put caller on top of it. So they basically buy downside protection and they sell a call in order to pay for that. And so this is also known as a long risk reversal when you have a caller. And so it's stock, it's the market plus a long risk reversal, otherwise known as a caller. This one uses a downside put spread instead of a simple put. That really reduces the cost of that downside protection, which is really probably makes sense most of the time for folks because that downside can get quite expensive. So this product, almost $21 billion in assets in it, which is big, right? So this thing goes in when they sell the call strike, for example. This is probably above where the market is trading. You're probably generating about 23 to 24 billion dollars in notional call selling into the market. So that is creating some flow of calls into the market. And so that's going to have an effect as we get into the sort of deeper aspects of the option trade itself. So expense ratio 0.57, 0.58 with some trading fees in there, I expect. Pretty decent sized turnover there. So this is not a set it and forget it type fund. We'll talk about the components here, and it's considered equity hedged. Equity hedged. So let's take a look here. We can see the top 10 holdings are some of the usual suspects: Apple, Nvidia, Microsoft, Amazon, etc. And we can see how this thing differs a little bit from the benchmark. So the benchmark is the S&P 500 index, and we can see that the fund in communication services, for example, where Meta would be, is a little bit underweight compared to the S&P 500. In consumer discretionary, it's a little bit overweight. In consumer staples, is a little bit underweight. So you can see this thing is a little bit discretionary, is a little bit more risk on, right? So, in a good economic environment, discretionary is going to do a little bit better. It will do more poorly as things soften. And they're a little underweight staples, which tend to be a little bit more defensive in nature. So tend to be, not always, but tend to be. So interesting kind of positioning that they have here, a little bit more aggressive in the one sense, but also you can see that they're a little underweight in information technology. So kind of an interesting mix here of names. MasterCard, Visa tend to be kind of in those, you'll find those in the low vol funds and things like that. Tesla, 2%, certainly not for the faint of heart. So a lot of beta in this portfolio. So it invests in a portfolio of US large cap stocks while employing a disciplined option strategy that seeks to reduce downside risk in falling markets. So that's exactly how it's designed. And so if the S&P 500 does fall, they have a specific strike where the fund is protected below that strike and down to a lower strike that they sell. So we can see here a number of holdings, 161. That's different from the S&P 500, which would be almost 500 names, of course. Beta 3 year is 0.5 to the S&P. So you look at that. That's about half the volatility of the S&P 500. So why would that be? Well, we'll talk about that because basically this fund is limiting upside, which it often does, unfortunately, and it creates a cushion to the downside. So it's lowering volatility to the downside in the event of a serious sell-off, but it also lowers volatility. People sometimes forget this. It's lowering volatility to the upside. So sometimes lower volatility can be a positive and negative, right? If you're lowering volatility to the downside, that's great. But if you're lowering volatility to the upside, then you're limiting upside movement, and that may be a negative. So it's a little bit of a give and take here because of the way this is structured. And the evidence is right in the performance. So let's look at the performance over the last 8 or 9 years. We can see that in very strong uptrending markets, this fund is going to underperform. And in difficult markets, it's going to generally outperform. So let's look at a year like 2017, where the market was just kind of low vol, but just kind of marching straight up throughout the whole year. I remember we barely had a downtick that year. Well, sure enough, we can see that the fund made 12.7, returned 12.7%, but the underlying basket, the S&P 500, yielded 21.83%. Now, I know they're not exactly the same fund. There's a different construction to each of them, but we can certainly use the S&P 500 as a benchmark. That's kind of what they're sort of aiming for, probably a little bit less heavily weighted to technology, but sort of similar. So we can kind of compare the two to get an idea of how we're sort of getting that low volatility. Well, look, in an upward year, we had lower volatility, but not for the right reasons. The market, the index did way better. Then we look at in a year like 2018, the broader index lost a little bit more than the fund. So JPM Caller Fund, the hedged equity fund, outperformed. Well, let's look at another difficult year. So here's 2022. S&P was down around 20%. We can see right here, down about 18.11%. Well, the hedged equity fund was only down 8%. So really amazing outperformance there. So that's what you're getting. You're getting that downside put spread really kicking in and lowering that downside participation. So that's an amazing outperformance. I'm sure they advertised this year to no end because that's really, really impressive. And then we got a couple of very strong years from the S&P 500, and look at how the index really outperformed in both of those years. So this is where your lower beta to the S&P, and this is where your lower volatility is coming from. It's outperforming in difficult times, and it's underperforming in very, very strong years. So there's your evidence right there of really the kind of performance you can probably expect from a fund like this going forward. And that works for a lot of people because they sort of tell themselves, well, I don't need the full upside, but I need to sleep at night and feel like I'm being protected to a great extent to the downside. And this really achieves that goal. PE ratio 23, I believe that's forward ratio. That's probably a little bit lower. This is as of December 31st, the end of last year. So a little bit lower than the market overall. So a little bit less aggressive from that standpoint. And the average market cap you can see in billions, so 1,000 billion, so $1 trillion there for the average market cap, and a Sharpe ratio of 0.48. So let's talk about how this works from their very own summary from their website, which a Morningstar analyst has put in here. Delivers a promise of low volatility that can help investors stay the course during volatile markets. Well, that's true, as we're going to see what it does here. It layers S&P 500 options on top of the equity portfolio, which we talked about, 161 names, and sort of clamps the index. To offer downside protection, the managers buy put options with strike prices 5% below the market value, and they sell the puts that are 20% out of the money. So we say this is the kind of buying the 5, selling the 20. So they're, this is a 95-80 put spread in sort of options speak. They're buying that strike that is only 5% below the market, which isn't super far. And because they'd like to cut down on the cost of that protection, they sell the 20% out of the money. Now they make a little bit, they do a little better there because they're selling something that rides up the skew curve, right? So they're selling something that's quite a bit more expensive on an implied volatility basis, and they're buying something that's expensive but not as expensive as that put. So they're playing volatility edge there because they're selling something to fund something that's cheaper, selling something more expensive to fund something that's cheaper. We'll talk about that in the third video a little bit. So this structure basically protects the fund from losses between down 5% and down 20%. Below a 20% sell-off, you're not going to be protected anymore, but it's going to give you that full protection between 5 and 20%. Why full protection? Because normally when you buy a put spread, it costs you money, right? So why do they get the full protection here? Well, because they figure out what this put spread cost them, the 5 and 20 put spread, over a 3-month expiry period. And whatever that costs them, they are going to sell the upside call strike that pays for that, right? So think of it this way: if they pay $10 for this put spread, but that's not what they're paying. But let's say you paid $10 for the put spread, you're going to look for the call that, if you sell it, gives you $10. So they want to finance this downside put spread fully by selling that upside call. And as they show here, the call strike can move around, right? Because skew is going to change, right? The cost of downside protection is going to vary even versus the upside call skew. So this is a moving and evolving target. So it's going to change. So it's not always going to be the same. You're not selling a call that's 3% out of the money every time. It's going to vary. And they tell you right here, it's going to vary between 3.5 and 5.5% above where the index is at the time that they strike the new structure on this, which they do every quarter, every 3 months. So what the fund does is it basically cuts down on your downside risk. So if the market really plunges 20%, you are going to be protected from 5 to 20% out of the money. So this is what it looks like. So here's your S&P 500 chart right here. We've got the recent highs at 6,200 almost. We've got the recent lows at close to 5,500. And so where this structure is positioned right now is, here's your long strike. It's at the 55.65 strike. So when they structured this, the market was higher than where it is now. And this is basically where that 5% out of the money strike was situated. So they bought the 55.65, then they went to the 20% out of the money strike, and that was the 4,700 put. So they bought the 55.65 put, they sold the 4,700 strike put to finance some of that, and that gives them their between 5 and 20% downside protection. And what they do is they say, well, what's going to pay for this? Whatever this cost us, what's going to pay for that? Well, they look up and they go and they figure out, well, which one of these calls is going to cover the entire cost of this put spread? And at the time, that happened to be the 61.65 strike. So here is your JPM hedged equity fund. They are long the market. They are long this put spread here for a cost, and they have sold this upper call, which is basically a covered call, right? So think of this: if you didn't do this put spread and you just sold this call against your market holdings, it would be just considered a covered call, right? You're going to be receiving whatever it is, $10 for that call, and that's going to create a little bit of an upside cap to your performance. So what happens with this fund? Well, it is limited to the upside, right? Because there's no free lunch here. You have purchased some downside put protection, but you have paid for it by selling this call. But you are obligated to sell away your market exposure above 61.65. And we almost got there, right? We just about got to that level before this recent sell-off began, and then we got down to the put strike. So what's interesting about this structure this month is that for some time, we were actually near the long put strike. So, which typically in a bull market, you're going to be pushing towards that call strike most of the time. And so in November, for example, I remember very distinctly, we were right around that 57.50 call strike, and the market basically kind of bounced around that level. And we're going to get into this in the second lesson. The when you're right around that long strike, that is creating a dampening effect to volatility, because market makers have futures and stock to hedge by selling above the strike, and they have it to buy below the strike. So it creates this sort of clamp around there. In this case, you were near this strike that the market makers are all actually short, because when they need to buy this, when the fund needs to buy this put and sell this put, who has to sell it to them? Well, the market maker sells that put to them, right? So if the fund needs to buy this put and sell this put, then the market maker ends up being short this put and long this put. The fund is also selling this call to fund the put spread up here, and so the market makers end up being long this call. So I wrote here, market maker does the opposite of the fund. So when this structure comes in every 3 months, what it does is it supplies the market with this structure, which is basically giving market makers a whole bunch of long calls up higher above the market. It has them short a bunch of puts down 5%, and it has them long a whole bunch of puts down 20%. So this is what the market makers are saddled with, and that creates an influence on market on the day of the trade, of course, but then on an ongoing hedging basis, right? So that's the key to this. This creates gamma effect throughout the period that this structure exists out there. And we're going to talk in the second lesson about how that can change. Early on, it doesn't have as much gamma effect, but as we get closer to the expiry, if we're near one of those strikes, it has a greater gamma effect. So remember, options exist through time and space. So the passage of time is going to affect how these affect the market, and the proximity to strikes is going to affect how this structure affects the market as well. So hopefully that gives you a little bit of an overview of how this product is structured, what it is, why it's constructed, what it's trying to accomplish, which of course we know now is creating protection. This fund, people who own this fund own the market. They have a limited amount of upside, right, which they're okay with, because what it gives them is downside protection between down 5% and down 20%. So, and the reason that this over time is going to give you lower volatility is because it's limiting your upside volatility, which is good volatility, and it's creating a cushion to the downside, protecting the full amount of your holdings between down 5 and down 20%. So it's lowering volatility. That's one of the things that option structures can do for you. Protection can lower volatility. Selling cover calls can lower volatility. So, it kind of all works to create this structure that basically gives people upside, but also gives them some peace of mind, some sleep at night. It's basically protecting their downside from a fairly severely sharp sell-off. Now, if the market does get below 4,700, they are now fully long the market again, right? So the investors in this fund are fully long the market below this put spread structure. So below 4,700, they are going to continue to suffer from any more losses down to wherever the market gets to. So in a severe 50% market sell-off, they are going to be protected for 15% of that, and they are going to continue to endure losses below the lower strike. So this is not going to be a perfect hedge for people, but it's going to hedge for probably a great number of scenarios out there, which is everything short of something extremely severe, and it's going to accomplish a cushion in the event of anything that's kind of, your just typical run-of-the-mill sell-off, let's say 10, 15, 20% sell-off, you get a down 20% year like 2022, and this should protect you to a large extent for that sell-off. Okay, so we'll see you guys in the next lesson. We'll get into a little bit deeper into the options and gamma.